Welcome back, everyone, to Grit Daily Startup Show. I'm your host, Jordan French. Really exciting to have our next guest on from Nirvana Finance. That's Nirvana.finance. We'll talk about doxing with Thomas Ruble. We'll talk about Bitcoin, next iterations, and the evolution of it. Thomas, welcome to the show.
Thank you very much for having me.
Yeah, super glad to have you. And since I mentioned the word, doxing right at this intro, the cryptocurrency and blockchain space, there's so many directions we can go in this, but I think it's important, for our audience, especially to kind of understand some of the background and context there. You had a different name, for a while, in the finance space for what are usually really good reasons. And that's changed. You're using, your real name, you're sort of out in front. If you could just unpack that for us, Thomas.
Yeah, the climate has palpably changed recently. The SEC's stated goal now is to go after fraud, which is what they should have been doing the whole time, rather than legitimate companies. They've been dropping suits left and right with Coinbase, other crypto companies that are high profile or low profile, sometimes even go after the exotic do-gooders. And I feel like ordinarily people get attracted to crypto as a way to, builders get attracted to it as a way to substitute anonymity for responsibility and accountability. And it's kind of a sad state of affairs that many crypto companies kind of operate in the shadows in order to avoid being accountable. A little bit of it is protection, because of operating in an area that can be gray. And a lot of it is just not stepping into the light and owning the work that you do.
And look, it's sort of a hallmark event. I don't think you're the only one who's, more or less doxed himself. And look, there's some really good loose analogies out there. Maybe they're direct analogies. Cannabis industry, sort of different aspects of pharmaceutical in the past. Things look and start out a lot muddier. There are often, like really aggressive actors. Sometimes those are government actors, like you just pointed out. I'm sure we'll bring up the SEC at least a little bit, just to share some of the news because it's relevant, and repeat it back to you for our foundation in context. The SEC had a slew of sort of investigations, as they call them, division of enforcement, that were lifted today or dismissed from some of the bigger names in the cryptocurrency space. But I think there's going to be some inquiring minds, wondering about you, Thomas, for those who are less initiated on you, and perhaps haven't heard your name before. Give us a foundation. How did you end up, and when did you end up getting into the cryptocurrency and blockchain space?
Oh, I'm a fairly cliche kind of software engineer, well, except for the fact that I started my career going after a philosophy PhD until I thought the better of it. I always thought I would be a professor. But then with one dark night of the soul, I decided that wasn't for me and switched tracks, got a higher degree in computer science, and just started going to work. I was attracted to software engineering because it gives you the same joy of doing, let's say, carpentry or gardening without all the calluses and sawdust. There's just this inventiveness and creativity that you can do at a cafe with a laptop. So I got to building. I worked in healthcare AI startups, banks, did some years at Google doing cloud infrastructure, and then crypto really started to come into the more public headspace, which includes my head. And I learned about this promise that you could create an application, bundle it up, load it onto a blockchain, and it becomes part of this immutable permanent record that anybody can come and access. After working at Google, where you need to go through 3 or 4 committee meetings just to change the color of a button on Gmail, the immediacy of this crypto development, where you could just build something, launch it, ship it, and then people start using it from all over the world, all around the clock, was very enticing. And I'm still here. So the enticement is still going strong.
Well, we're glad you're still here. And Nirvana, finance, Nirvana.finance, or website for those who are just following along and want to just check it out or even start poking at the app. Uh, it has, to some degree, some relationship to Bitcoin. Can you share, or is there evolutionary relationship to Bitcoin? Can you share more on that so that people have something to sort of hang their hat on or anchor to start?
You know, you can think of Bitcoin like the text for it. I mean, it's the text for everything. In 2008, Satoshi wrote this paper about this thing called Bitcoin. And in that paper, he was trying to come up with a system just for, I guess, what you would call settlement, for a ledger, a spreadsheet. How can you record a fact that you have 5 of these things and your neighbor has 3 and you can send some over and nobody can stop you? That's really the point of Bitcoin, is you remove the person in the middle that could say yes or no, which gives you this unmitigated access to do whatever you want with your Bitcoin. But then this disintermediation, when you remove the human in the loop, that also means that nothing can shut this thing down. It's like a mythological hydra where, if any state were to try to cut off one of its heads, 3 more would spring up. And it's this unstoppable ledger. And one of the things that Satoshi was concerned about, I believe he mentions this word in the very first paragraph, is that this stops fraud. You don't have to have a backroom decision maker that can have his or her thumb on the scale, change things around, fiddle with the numbers. You can't fudge the record with Bitcoin, and it stops fraud. And you would think that if somebody were reading that paper in 2008 and a time traveler from 2025 came back to visit them and said, good news, an entire industry sprung up around these ideas, you would say rightly, so we cured fraud in the future? And it's been anything but that, hasn't it? That somehow, probably from the hot ball of money that got injected into the space, crypto is known for being scammier than regular finance, more fraudulent, more shady, and a lot more fragile also. And that fragility gets expressed in the volatility, where Bitcoin's up 50% one day and down 30% the next month. What's happening is that Bitcoin as a technology solved the problem of what they say decentralizing the computers. They decentralized the network. There's no one guy with a book in an office keeping track of all of this. The ledger of who has what is totally spread out, and it is a permanent record that is honest and factual. But what they didn't do is apply those same principles. I say they, by they I mean us. What we didn't do is apply those same principles to markets. That Bitcoin as a technology, that's good crypto. And what makes crypto crypto is that it's open, anyone can use it, and it follows its own rules. And one of the things that Bitcoin was actually inspired by governments deciding monetary policies. They were tired of the Fed printing money, so they thought, let's have an algorithm that nobody can change. It sets the monetary policy. We all play by the same game. That was the idea of crypto. It's open. Anyone can use it. By open, I mean anyone can look at it. Anyone can use it. And then you have algorithms, not humans, making the decisions. So no one can get emotional and mess with it. But Bitcoin as an asset does not live up to those principles. Bitcoin as an asset is heavily controlled by entities like BlackRock, Michael Saylor's strategy, who knows who else. This thing that gets traded and has value, and you can sell it for $100,000 and buy it for $80,000, has these properties that have nothing to do with crypto whatsoever. And I know that might sound odd, but it's true. It's just a conventional kind of ETF that gets traded and people speculate on it and gamble on it. There's nothing in there when you look at the market for Bitcoin that screams crypto. Nothing at all. And in many ways, it's worse than gold, or worse than the US dollar, or worse than the S&P 500 as an asset because of how shadowy and fraudulent and heavily concentrated it is. I mean, not to mention that, well, I am going to mention that there's only 21 million of them, but I believe already 19 million have come out. So there's just a tiny amount that's going to go into new hands at this point. It's very, very, very concentrated in very, very few entities. Okay. How could you make an asset that lives up to that dream? How could you make an asset that has these crypto principles, which are being open, anybody can have a fair shake at using it, and there's no institutional Chicago market maker that's waking up at 9 a.m. and deciding, it'd be good for our shareholders if the price went down a little bit. What you do is you take the human out of the loop, just like how Bitcoin took the human out of the loop with the ledger. You can do that by having, an algorithm which runs the market. Pardon me. The asset that Nirvana creates runs in a market without market makers, just like the Bitcoin ledger runs with settlement and bookkeeping without bookkeepers. If you have a math function that's deciding the price if somebody wants to buy it, and the price if somebody wants to sell it, and the money that's backing up those sales, all controlled by a computer program, which anybody can look at, anybody can inspect, and everybody plays by the same rules when they interact with it, you have liftoff with a different kind of asset class entirely. The kind of asset that no central entity, no fickle human has really any say on at all. And that really purifies a market. It purifies a market where you just have buyers, you have sellers, and there's nothing in the middle besides that.
Yeah, absolutely.
So
Absolutely. And if we can, pause it. There's so many strings of the linen we could pull at, but maybe the first sort of instinctive question: is there something like this that we could ground ourselves to historically? Like, is there any example of this where, that does exist already? That's perhaps like algorithm-based price action rather than supply and demand, and certainly, right, your lobs at the commodity price action that is Bitcoin or pretty much anything else. We could concede the point. You're right. It's certainly susceptible to hostage taking. Whether there's 21 million of something or there's maybe billions of cocoa beans and silver. Right? There's a lot of great historical examples where commodities can be held hostage. Is there any sort of historical example that relates to what you're referring to, Thomas, or is this completely novel from a price action a mechanism standpoint?
It's novel. It's novel. I mean, this is digital money. So there are things you can do with email that you just could not do with physical paper. The fact that this is purely digital, it's purely, I'm just going to say it's idealized. There's no physical correlate to any of this, is a paradigm change that I think we're still unpacking. The idea in crypto that money really can move at the speed of light and that anybody can have access to it and that you can have inhuman, I don't mean that in a pejorative sense, non-human computer programs running this is a leap that we could have really only made, a couple decades ago when we had computers that were powerful enough to do this and a way to connect to them around the world. So this is a moment that is without precedent in our technological history. To have a machine, a computer, sand and electricity that can run this, and B, the internet so that anybody can connect to it and interact with it. This is it's a weather pattern that hasn't formed before. One of the other properties of the Nirvana asset is that it has a built-in guaranteed minimum floor price to it, which is to say that if there were a panic sell in the market, if everybody wanted to sell, what ordinarily happens when you see somebody selling, you're looking at the red line trending down and down and down, and you're asking yourself, where is the bottom? Where is this going to bounce and turn around? When is there enough blood in the streets that I'm going to buy? And it's anybody's guess. That's timing the market, and very few people are lucky enough to get it right. Assets usually don't have a minimum price, a known price where it can go no further. And not even gold has that, and certainly not Bitcoin. Now, there's nothing about Bitcoin which prevents it from going to zero. That's very unlikely, but there's nothing in the code, so to speak. I could keep it above zero.
We could go a step further, and it wasn't in too recent, unbelievable, perhaps from like an elementary economic standpoint, but oil, right? Like just post-pandemic. If my memory serves correctly, went negative, right? Which is
there you go,
plausible. So I mean, knock on wood, right? Perhaps for those who might have bought a little bit or a lot of Bitcoin or perhaps some cryptocurrency, at least theoretically, it seems like it could be a negative number when something's a commodity.
And I don't mean to knock on Bitcoin. To say it's not a crypto asset is not to say it's a bad asset. It's a perfectly fine asset, and like any assets, the price could go anywhere. I'm just saying we have not yet, well, until now, created an asset that is like crypto. We haven't created an actual cryptoified asset. Something which, again, the hallmark of crypto, and the reason why it kind of lives its parallel life away from conventional finance, is the lack of human intervention. If crypto is just going to have humans running the show and pulling the puppet strings, they're just trying to get out of jail free by, calling themselves a crypto company, regulate us differently. Well, I'm sorry, it's exactly the same thing as conventional finance. It doesn't matter that it runs on a blockchain or whatever. You're moving shekels around, and you're doing it with traditional market makers, and you got to protect consumers and all that good stuff. But what makes a crypto asset properly crypto is the lack of human intervention, the replacement of humans with algorithms. And when you do that, and very few people that I can think of have even attempted this, when you do that, you open yourself up to a whole new dimension of possibility. One of them being that you can have the algorithm guarantee a price. You have an algorithm which is essentially an emotionless treasurer. And the treasurer holds the money in reserve, and nothing's going to change its mind, because again, it's a computer program. What Nirvana does is, as it collects capital, it makes sure to set it aside. There's no board meeting that can make a decision to remove it, just as there's no board meeting that could increase the number of Bitcoin in supply. It's all just programmed. And the protocol can guarantee, like Fort Knox, I guess we're going to find out when we audit it finally, that there is enough cash held in this communal reserve so that if everybody wanted to sell, you would at least get that price. And that's just not true of Tesla stock or gold or oil. I mean, if everybody decided to sell, if literally everybody wanted to sell, I guess the price would go negative, because by assumption, nobody's wanting to buy. But when you have an algorithm, it's not a person. And so if everyone wants to sell, that's fine, because the algorithm is the other side of that trade.
Yeah, absolutely fascinating from so many standpoints. I think the sort of widest common denominator that'll engage on this, though, the sort of numbers and math nerds out there really want to know, because it's an algorithm, right? There must be inputs, and if we could just unpack that a bit, Thomas, like what are the inputs? Like how does this algorithm, decide what the price should be?
Sure. I mean, as a crass example, and if I just had a bag of checkers and we're going to use that for some game that we're playing. I'll set a price for them. It's $1 for the checker. You give me the dollar. I'll put it in a lockbox. You get a checker. Next guy shows up, and you bought. That's demand. So the price goes up a little bit. The next guy pays $2. I put the $2 in the lockbox, give it another checker. Next guy shows up, it's $2.50. Where's that price coming from? I have a math function for that. Every time somebody buys, the price goes up a little bit. So now the price of checkers is $4 on the market. You got in early. You bought low. You get to sell high. And so you sell it back for $4. I'm like, oh, I got the $4 for you. Pull it out of the lockbox and give it to you. I'm just following a script. I'm just following the rules of the system. And then if the last guy sells the checker back, I still have the money in the lockbox for that, and I can honor that sale. There's not going to be a problem where I'm empty-pocketed and I don't have the money for the last holder of the last checker. The idea here is that this is the asset for a strategic national reserve. This is something that is a safe bet. If you wanted to spend $1 trillion on Nirvana, that money will be there. You're not going to have a panic in the market where like, I'm sorry, that was a bad investment. It went down 90%. Try again with a different asset. That was a bad bet. Everything's a bet. But when you have an algorithmic store of wealth like Nirvana, this is a bet that has capped risk to the downside. This is something that could absorb a nation's treasury, or it could be part of a person's retirement fund. The hope with buying Bitcoin is that the price goes up. The fear is that we'll lose interest and it'll go down 90%. Nobody knows what's going to happen. But you can do better. You can have a crypto asset where at least when you buy, you know exactly how far down it can go. You know exactly how much you could possibly lose in the worst case. But you don't know how high it can go. It's still a speculative investment. This token could go up 1,000,000%, 1,000,000,000%. It just depends on how many people come and buy it. But at any point, your risk is capped. You don't have that sad state of affairs when there's a crisis in the markets and your 401k gets evaporated. Something that you were really banking on when you retire, but because of exogenous factors, it's gone. We can really do better than that.
And I definitely want to go back to your well-grounded, I think, and really illustrative checkers example. But let's set that aside for just a moment and talk about that price floor. What is the net mechanism then for Nirvana to have a certain price floor at a given time?
Let's say I've sold 1 million of these checkers from my checker stand. And every time I'm just keeping a note of what the price is, how many I've sold. I've got my slide ruler and it's determining what the next price is. I'm just, again, following a rule. When people buy, the price goes up, let's say 1%. When people sell, it goes down 1%. I'm just following that script. So I've sold 1 million of these, and maybe I have $10 million held in my lockbox. All I do is I take 2 million of those dollars and I set it aside in another lockbox. So there's $2 million, 1 million checkers floating out in circulation, but I've reserved $2 million. The rest of the 8 million is used for buying and selling up and down. But I know that if everybody came back, I have at least those $2 million, so I can guarantee that everybody gets $2 a checker, worst case. So we'll make it just a little more complicated. Yeah, I've got this function that's determining the price, and I'm just following my rules. But then on top of that, I have another function which is saying every now and again, scoop up some of that money, set it aside, don't touch it. Don't touch it. No matter what, that is the reserve backing all of these checkers that all these people have bought. So in the rainiest of rainy days, if everybody wanted to sell them back, I know that I've got that. I don't think we see this in the regular world, the conventional world, because humans always eventually have a crisis of conscience. and they reach into their own cookie jars, or they start borrowing against their assets, and they make a mistake. They take on too much risk. That's how a bank fails. You give the bank the deposit, bank lends it out, maybe they buy some bonds, maybe they do some risky investments, and oops, your deposits are gone. If you strip everything down, there's no bank CEO, there's no board members who are perversely incentivized to turn a buck. You just follow the rules. You can guarantee geometrically that there's enough money in this lockbox at any time. So if there was a run on a bank, everyone gets their deposit back. And ordinarily, that's what people are supposed to be doing with these crypto companies. That is the idea. They just rarely go far enough. And there's still managers and deciders and committees that make mistakes. And that's why crypto companies like FTX failed.
Yeah, certainly there's a rent seeking aspect, right, to almost anything in finance, Thomas. And when you do have, a bolus of capital, however it got raised through some, security sale, some commodity sale, perhaps in many cryptocurrency examples, or really sort of any other way to raise funds, there's also incentive, right, to make it productive capital. And that is where certainly the humans, as you describe it, get in trouble. FTX is a great example of that. Effectively, it's not even my point of view, but broadly it operated like an unregulated hedge fund without telling anyone, taking in capital and redeploying it elsewhere. Perhaps not very good tracking or record keeping, compounded the
You're
problem.
being too humble.
Yes. Well,
that's not an opinion.
yeah. What is there any disadvantage that you see, perhaps, to sort of to repeat this back to you, almost behaving like Nirvana behaves like an insurer, an algorithmic insurer on its own cryptocurrency? Huge advantage, right, to keep a floor on a price. But is there something that sort of investors or other stakeholders lose because of that?
Well, there are no stakeholders, just like there are no stakeholders of Bitcoin. Virtually every other crypto project since Bitcoin sets up a foundation, and they raise money, and they have a treasury, and they have investors, et cetera, et cetera. Not here. The best way to appeal to your own better angels is to get rid of the shoulder demon. Like, you don't keep a bag of cocaine in your bedside table, because you're not going to be able to help yourself if you put it there. I didn't give myself any of these assets. It's a purely open, organic market. There is no treasury. There is no pile of these things that are under mine or anybody's stewardship. There's a purity to this. The reason so many crypto companies get into trouble is, do you remember NFTs?
Certainly,
Remember
yeah.
that craze?
It's for a while. They're still sort of around, and some have.
They're still sort of around. They're permanent, right? They're part of the blockchain. Look,
Right.
the thing about them is that they're digital. You can just hire a marketer and print 100,000 of these things and just say, come and get them. And people will buy them. And they cost you nothing to produce. There's no cost basis for you as the creator. So what you do when you create these NFTs, if you want to get rich quick, is you print 10,000 of them in your vending machine, and you just take 500 of them. And you try to pump up the price, create this euphoria, and then you sell the 500 that you gave yourself on the people that you're supposed to be treating as your customers, as your users. You get this perverse incentive. It's all the dump, but none of the pump, because you're not even buying in that case. You didn't buy low, sell high. You didn't buy at all. And you just sell to other people. So crypto companies often cannot help themselves from the ease of just pressing a button and giving themselves 1 million tokens. Maybe you've heard of Ethereum, which is a Bitcoin competitor. It came a little bit later, and that's just what they did. When they launched it, they were thinking to themselves, we put a lot of work into this. We should just give ourselves a bunch of tokens that will fund our operations. And it hasn't been surprising how this has turned out. They're kind of imprisoned by the burden of managing a treasury of a token whose only market value comes from them selling it on the people who they want to have buy it. And you get really destabilized markets and sentiment and chagrin because of this. So just wipe the deck. Again, back to Bitcoin. There's no foundation. There's no treasury. We don't even know where the guy is who invented it, or if he even is a guy. And Nirvana started on those exact same principles. If this is truly going to be eternal, if this is going to outlive me and outlive everybody who has it today, you have to start from zero. And you have to give yourself no power and no influence so the thing can just run itself, even if the entire team that's been building the application gets abducted by aliens tomorrow. That's how Bitcoin works.
Let's hope
And as far as
that
I know,
right.
Nirvana is the only other crypto asset that aspires to that level of purity.
Certainly fascinating and conceptual, and really appreciate the huge walkthrough and detail and some of the analogies. Where are you seeing interest? Is this ultimately a really big play, like sort of government level tool that is just different than the commodity like cryptocurrencies out there, or is this some other direction, perhaps a ground up retail play? Thomas?
Yeah, there is a dark forest of crypto that most people on the outside don't know about. You have to be addicted to Twitter to be apprised of everything that's going on. In the peak of this euphoria, there'll be 70,000 new cryptocurrencies created per day. And people gamble on them and speculate, and sometimes they rise up and live for a year or so, and you have these niche communities that build around them, and maybe they'll be traded on Robinhood, and your friend might let you know about the latest meme coin. Trump, for instance, launched his coin. He had his own cryptocurrency, still does. We'll see what happens. But relatively small compared to anything you would find on the S&P 500 or packaged in an ETF. To answer your question, this is designed to be a government level kind of asset, not a niche play, not a small cap. There's nothing about Bitcoin or Nirvana that limits the size that it can be as a store of value that millions, if not billions of people hold on to as a way to park their wealth. But like Bitcoin, it takes time, years, for there to be adoption, integrations, listings on Robinhood. Nirvana's only been live for about 3 months right now. And it took how many years before somebody with a phone and a credit card could purchase Bitcoin on an exchange? More than several. It was a very small market for Bitcoin when it first came out, and you had to be brave and bold to navigate the software to use it. And the situation is better today than it used to be. There are consumer apps that can access this, but you're not going to find it on, say, Robinhood for some time. And part of that problem, again, is that like Bitcoin, it doesn't grow on trees. The only way this token exists is because people came and bought it. There wasn't a million of them printed out of thin air that then I could pick up in my hand and take to Coinbase, let's say, and ask, would you please offer this over there? It has to grow organically. But when something grows slowly and organically, that's how you build a gemstone rather than sandstone.
Yeah, it goes back to maybe a much looser and wider use of the word stakeholders, but it's worth asking the question: Do you want retail investors in there? Like, do you want the audience to go perhaps speculate, which is really what they would be doing?
Absolutely. What makes an asset strong is many hands holding it. What makes an asset weak is when you have one big stakeholder, when you have too much concentration. This sounds like fear-mongering, but if Michael Saylor keeps buying Bitcoin, and if he keeps borrowing against it, And if the price moves against him and he is forced to sell his treasury, that will drastically destabilize the market. The problem is concentration in that case. Well, the problem is really leverage and margin calls. But if it weren't so concentrated, it would be much, much more resilient to all the little fluctuations and minor crises that people have. So, no, lots of people that hold this token just hold $20, $100 of it. I don't hold that much. I hold a lot for my respective net worth, but there are people who I don't even know that have amassed fortunes of this in the last few months. It's for everyone, just the same way that Bitcoin is for everyone, and the same way that the S&P 500 is for everyone. You have players that have 8-9 figures of it, and people who have $20,000 that they've dollar cost averaged in over the last 5 years. Doesn't matter.
That as a product has been successful. The concept that you have though, for sort of what you described as algorithmic, price making or price action, it's so different from how most anything trades and most cryptocurrencies behave like commodities. You touched on the volatility that's there. This question is coming and it's a natural one to ask. Have you gotten inbound interest from sort of other protocols, other market participants, let's call it that, who've expressed interest in something that does take more of that human element out of it and trades differently, like Nirvana does? Thomas?
Every day. Just this morning, somebody texted me asking, "Is this you? Did you create this copycat?" These all the same language, all the same dynamics. I'm happy to see that. I welcome the forks and the clones and the evolutions. There will be evolutions. This is a solution, but not the only solution. And if you're listening to this and you're curious, come find me on Twitter or X and reach out. The reason why I want to see more clones of this is because I genuinely care about the crypto space, and I'm tired of it being besmirched with this reputation that it's just scams and Ponzi's and pump and dumps, and B, that people are victims of these pump and dumps all the time. The worst thing about a gambling addiction, all addictions are difficult, but what makes gambling such a killer is that it happens in the privacy of your own bedroom. Your friends and family don't even know, what kind of burden that you're under. And it's very hard to get help or an adjustment because of that. And crypto has really leaned into selecting for those kinds of users. And I just don't want to see the space play into that. There's something that we're doing in crypto, which is to democratize access to financial primitives, to remove intermediaries and also bring down cost because of that. You can use crypto applications for a bank, for a line of credit, with way less fees, way more transparency than you can get with other conventional providers. That's a good thing. That the demon on the back of this whole sector is the outright fraud, the scams, the things that take advantage of people who are hoping for one thing, and then unbeknownst to them, they get taken advantage of. FTX being, an example of that. It seems safe, and they're breaching the terms of agreement, as they're gambling away users' deposits.
Certainly,
so, yes,
certainly identified some real flaws in the system, and I must say, wide-ranging conversation here. Really great deep dive. Into some of the issues that ail the industry, and really novel approach, I must say. To sort of tackle it in a completely novel way, at least from what I've ever seen before. From a time perspective, I do want to give you the last word, Thomas.
The last word is just thank you very much for your time. This was a great conversation.
Oh, we really appreciate you being on the show. I think we'll get a lot of interesting inbound, in commentary, and certainly send it your way. This episode will be out live on all the channels that you all and the audience listen to. including Apple Podcasts. You'll see the article, Company Live, for all those Mac, iPhone, and other Apple product users on Apple News. That's apple.news. Nirvana Finance, check them out. That's Nirvana, just like the way you think it's spelled, Nirvana .finance. And sounds like Thomas is also welcoming you to contact him directly. That's Thomas Ruble. And you're on X most commonly, Thomas?
I am. Under my nom de plume, Sid_Nirvana_Phi.
There you have it, everyone. Reach out, certainly, if you're interested. I think we'll be hearing more about certainly this concept, if not even more, from Nirvana and its roadmap, as people do look into this as an interesting, certainly very different approach to price making. But we love having you on the show. Really appreciate you.